Bismillahirrahmanirrahim. So today we will discuss posted prices. This lecture is based on this article, Douglas Davis and Charles Holt, Markets with Posted Prices, Recent Results from the Laboratory. Now, this is a very important paper. Basically, it shows that the ideology of Neoclassical economics is not correct. Even though the authors are very eminent and respectable experimental economists, and the article is excellent, it was published in a Brazilian journal. It could not get published in English language journal because economists do not tolerate attacks. And this paper, and normally experimental economists hide their dissent. So even when the experiment proves that the mainstream theory is wrong, they say, well, it means that the mainstream theory is in need of some modification, instead of saying that it just shows that it is wrong. So because in this article they did not do that, they just said what the article showed, so their article was not published. So basically, the central ideology of neoclassical economics, which is being taught to students all over the world today, brainwashes them into believing that free markets lead to efficient outcomes. And if people ask how, so they say this is the magic of the markets. There is no explanation for this. Yani supply and demand equilibrium comes about, but how? Well, there is this story of the mythical Walrasian auctioneer, which never works. There is the second story about full information and zero transaction costs, how if any supplier lowers his price a little bit below the equilibrium, everybody goes to him, and if he increases his price above the equilibrium, then everybody leaves him. Now this doesn't happen in the real world. So both of these explanations which are given to the students are wrong. They don't correspond to the reality. So in fact there is no explanation of why supply and demand theory works, except that it works by magic. So now, as we have been discussing in the case of the oral double auction, the actual exact market structure, which we have called microstructure matters, what sequence you do things in, who gets to talk, who doesn't get to talk, all of these things, whether it's sealed bid or whether it's oral auction, all of these things make a difference to the outcome. So there is a huge literature on oral double auction. Oral double auction results get published quickly. That's because they seem to support the classical theory. And in fact, that is how economists treat this. The economists say that the oral double auction proves that the Walrasian equilibrium theory works, even though this is not really true. So the basic results of the oral double auction, there are actually three results that come out of most oral double auction experiments. One of them is that in any round, the last trade usually occurs near the equilibrium price, and this is taken to mean that learning occurs through the process, and in the end people converge to equilibrium. This is not the right interpretation of this result, but this is how it is interpreted by economists. The second result is that if you repeat the exact same setup multiple times, then prices converge to competitive equilibrium, and all the bids are, this time instead of being the last bid, usually the markets start out in competitive equilibrium and stay near competitive equilibrium. So now this proves that if people have a chance to learn about the market, then they will be trading at competitive equilibrium. The third result is that in oral double auction you usually get very high efficiency. So these are the three basic results which show that the theoretical prediction that free markets work actually works in reality. That's how the economists argue. So it proves the magic of the markets, that even though in oral double auction you don't have the conditions, you don't have full information, you don't have you have small numbers of traders, you don't have large markets, still competitive equilibrium works, and it works by magic. Nobody knows exactly why it works. In fact, people have said that why it works is a scientific mystery, because there's no reason for it to work like that. Even the Gould-Sunder results, which show that the traders don't need to be intelligent, they just need to make sure that every transaction is loss-free. They don't make losses, and that will automatically lead to convergence. So basically the conclusion is that as long as you have a market, people are buying and selling freely, then you will get convergence to competitive equilibrium, regardless of whether or not our assumptions are satisfied. So this also provides justification for ridiculous assumptions which are made, that look, we are making these assumptions, but our theory works even when these assumptions don't hold. So now we have to see through these claims, and in fact this paper is about that. It shows that, so these claims that the economists make, that look, our theories work, and they are proven by the experimental results of oral double auction, this claim is not valid. The economic theory of supply and demand is not proven by the oral double auction results. So this is a claim that is wrong. So first thing, we can look at the Gould-Sunder results and reverse them. Actually, Gould-Sunder shows that the learning that is required to achieve equilibrium does not take place. So then there must be some other reason to explain why convergence to equilibrium takes place. It is not due to learning. So the result is that there are two results. First of all, if you have a symmetric supply and demand curve, then if all transactions take place within the triangular portion in which the feasible trades exist, in the sense that the feasible trades are where the supply price is above the supply cost is below the demand value. So if you just pick points at random within that, the average value will be at the midpoint, which will be the competitive equilibrium. So that's an artifact of the experimental setup. If you change the curve slopes so that the supply curve is more steeply sloped, then the average will not occur at the competitive equilibrium. And people have shown that that is also true. So the idea that in experimental markets the average price is close to the competitive equilibrium price, and that supports supply and demand, this is wrong, because that's an artifact of symmetric supply and demand curves, which are often used. The second artifact is the Marshallian path, which is not mentioned in the literature. As long as you have supply curves and demand curves which are sloping, not the box-shaped ones, then as long as we make sure that the highest price, the highest value buyer is buying from the lowest cost seller, then automatically, and this sequence continues, then automatically the last trade will take place between at the equilibrium point. So automatically you will get convergence. And the way to see that this is an artificial result is that there is no real sequencing in real world markets. And so we can artificially sequence things. We can, for example, we can say, let all trades take place at the same time. Then there is no sequence. And so there will be no last trade, so it will not automatically converge. And then the result that economists will say in that situation is that the average price will be close to equilibrium. But that is true only if the supply and demand curves are symmetric. If the supply and demand curves are not symmetric, then the average will not be competitive equilibrium. So basically these results are false and misleading, and they are widely cited. These results do not support competitive equilibrium, even though it is claimed that they do support it. So we can make all trades simultaneous, or we can set it up so that the highest cost seller and the least value buyer start first. There will be no trade, but if we go in that reverse Marshall sequence, then actually reverse convergence will take place. The first trade that happens will occur at the equilibrium, and then subsequent trades will fluctuate away from equilibrium. So this is just a matter of the experimenter arranging things, and if the experiment arranges things one way, one thing will happen. And what it has to do with the real world, nobody knows. I mean, you have to show that the Marshallian path occurs in the real world, and in fact it doesn't. I mean, there's studies which show that trading does not occur on the Marshallian path in real world situations. So these are the two things. We can also confirm, we can create experiments in which there is no Marshallian path. If we make a box type, so flat supply and flat demand, then the predictions of the model do not work. The last price does not converge, and in multiple rounds you do get convergence. You don't get convergence in one round. The Gode-Sunder results don't work because there is no learning. And so basically that proves that it's the Marshallian path structure which causes the Gode-Sunder results to work. So the failure to understand and explain Marshallian path is why most of the results misinterpret the results of the oral double auction, and they think that it supports competitive equilibrium, whereas in fact it does not. And these results of convergence are due to reasons different from those which are cited in the textbooks. The third problem is we can institutionally set up things so that we try to maximize trade. I mean, and then we will not get anything like supply and demand. For example, if I say that, okay, as the Walrasian auctioneer, instead of walrus, I go to say that, okay, let's try to just match up the costs with the values. In that case, we will get maximum trade, minimum surplus, and we will we will get multiple prices automatically. All trades will take place at different prices. So this is radically different, and as I've explained, this could be the efficient outcome in certain circumstances, which we will see. So the idea that one of the pillars of ODA is that the last price is close to competitive equilibrium and the average price is close to competitive equilibrium in one trial. So as I've explained in the last slide, neither of these things is actually true, in the sense that it is an artificial structure, it's an artifact, it's not something which automatically occurs regardless of how you do things. And we can rearrange things to make these artifacts disappear. If we if we destroy the Marshall sequencing, then the convergence will not occur and the last price will not be close to competitive equilibrium. And if we try to maximize trade, we will get nothing like supply and demand. So we can, by using different types of microstructure, we can get different results. So then the question, also if the supply and demand curves are not symmetric, then the average price will not be converging to the competitive equilibrium. So the question is, since we can get all sorts of results, which one of these is applicable to the real world? So then you have to take a real world situation and see which one matches, which is never done. So if we don't do that, then we can't make any claims about how the ODA applies to real world until we make a specific match that this particular structure is matched to the real world. The second pillar of ODA, which proves that competitive equilibrium works, is that if you have repeated trials of ODA, you take the same supply and the same demand, and you repeat it, then you do get convergence to competitive equilibrium, and that's pretty robust result, happens all the time. And the economists argue that it proves the magic of the markets. And why? This is because convergence occurs without full information. But the problem is that there are, to my knowledge, no real world situations where you have exact same supply and demand and you let people learn and then you give them a chance to replay that game. In the real world, the demand and supply are continuously changing. And so this idea that we get the chance to play the game again, it's just like your computer game that your character dies and then he gets a new life and he starts all over again, and so then you can practice and learn, but in real life you only get one chance. And if that, so once you take this point of view that there are no repeats in the real world, and then you say that the oral double auction disproves competitive equilibrium, because whenever we run it, we never see anything like computer behavior. You get lots of trades at very different prices, and so instead of saying oral double auction proves competitive equilibrium, you can just as easily argue that oral double auction results disprove competitive equilibrium. It doesn't happen. So basically the economists think that the convergence occurs by magic. When we do real world experiment, we see that magic doesn't work. And so you can make it work by a number of tricks. For example, if I set up the Walrasian equilibrium situation in the artificial market, I say, okay, here's the price, what's the demand, what's the supply, and then I keep adjusting the price until I equalize, then I will get to competitive equilibrium. But does that prove that magic works? No, because I made it work. Just like that, the economists make the competitive equilibrium work by setting up artificial structures which create equilibrium outcome, but if we set up different artificial structures, we get different results. So definitely this does not prove. But as I said, if you write an article which says that competitive equilibrium is disproven, then you don't get to publish it in an English journal, and if you get to publish it in Brazil. So otherwise, if you take the same result and present it as saying, oh, this is a wonderful result, it shows that competitive equilibrium works, then you can publish it in American Economic Review. So okay. So the third pillar of oral double auction is that it produces high efficiency. Again, this is used by economists to argue that if you have free markets, then this will produce high efficiency. So first of all, instead of the technical definition of high efficiency, you must understand what high efficiency means in real world terms. So basically, if you think of your cross the demand and supply curve, so one thing that is needed for efficiency is that all of the trades on the left hand side, the place where the demand is greater than supply, should happen. If some of those trades don't take place, then you will get loss of efficiency. none of the trades on the right-hand side, the place where the demand is above, the demand is below the supply, should happen. That will lead to inefficiency. Of course, it will not happen that a high cost will sell to a low value, but what can happen is that a high cost person can sell to a high value person, and then that trade will block the possibility of that high value person buying from a lower cost person. So that's supposed to be inefficient. And the inefficiency comes about because you're saying that this demand could have been fulfilled at a lower price. So we are using expensive production methods to satisfy demand. Now that is true, but at the same time there is some demand which is remaining unfulfilled because of this. So when it would have been possible to satisfy all demand. So now the question is the surplus the right value, right measure of efficiency? Suppose that we have essential food items, so then which are needed for survival. So then the demand and supply will say that half of the people will go unfulfilled because the profits are not there. But now suppose we say that profits don't matter, what matters is that everybody should get bread, then the criteria of consumer surplus becomes the wrong criteria. So efficiency is not achieved by the market, it is achieved by alternative structure in which you try to maximize trades. And that leads to entirely different results. And in this result, everyone satisfies us, everyone gets what they need. The buyers satisfy their values, the sellers satisfy their costs, nobody gets surplus. But the question is surplus, yani profits, more important than feeding everybody? So this is the question. Well, in the economic theory, the way it is set up, money is everything. So people who get money, they can get everything, and distribution is nothing. So as long as somebody gets money and some people don't get to buy bread, it's the total amount of money that is the total amount of profit generated by the system to both buyers and sellers is the measure of welfare. But as we can see, this is not a natural measure of welfare. In some markets it may be correct, in other markets it may be wrong. So consumer surplus is not the right measure of efficiency. You consider Pakistan's educational system, where there are two types of education. People who have money can buy high value education, and people who don't have money get to go to Urdu medium schools. So this is kind of whoever can afford. So different types of products for different types of people. This is what the market generates, and this is not necessarily the fair, equitable, just system, and not necessarily the efficient system either. So I've already explained why creating maximum money surplus is not the right measure of social welfare. Yeah? So, one of the assumptions of economic theory is that the cost of an item measures the social benefit. So, the market cost is equal to the market price is equal to the social welfare. Now, there are many things in which this is not true. So, the market price of some things is not a correct measure of its social value. Education being a prime example. So education creates a lot of positive externalities. So we should be trying to provide everybody with education, even though cost benefit means that the people who have demand education, if they don't have money to pay for it, then the market demand is not there. So according to the consumer surplus, we should not be providing them with education. So when the market benefits and costs are different from the social benefits and costs, then the market provides a bad solution, and the market measures of efficiency are the wrong measures, and this often happens in reality. So if the activity is socially valuable, then we want to maximize trade. This will involve doing things very differently from what the market wants us to do. And if the activity is socially valueless, like gambling or drugs, then we want to prohibit it. So if we allow trade in drugs, it will increase our GNP and it will create surplus for the sellers and surplus for the buyers. But we ban this because it's not efficient, because it causes negative externalities in the society. So just like we need to ban some activities, also we need to encourage some other activities. And in a third realm where items which are neither socially valuable nor socially harmful, the market can be allowed to operate. So this so-called market theory applies one measure to everything, and that is not justified. These points are not covered in the Davis Holt article. Davis Holt article says that economists claim that oral double auction proves that competitive equilibrium works, but this is not true. He doesn't go into the arguments why oral double auction itself is not a proof. This is what I have done. He says, okay, let's concede that. Okay, let's assume that oral double auction proves that competitive equilibrium works. He says that oral double auction doesn't take place in the real world except in some very small, limited number of stock market situations. In the vast majority, 99% of the markets we see in the real world are not structured where both sellers and buyers are competing with each other in a common platform. If you have two stores next to each other, they still are not competing on prices. And if the oral double auction type results hold, then you cannot have two stores which are neighboring to each other having different prices. And the same is true of your competitive equilibrium theory. If the supply and demand theory is true, then you cannot have one grocer selling tomatoes at 50 rupees and the other one selling them at 35 rupees and being next to each other. But it happens every day. So he says that the structure of market which is more realistic is the posted price. The posted price structure is that every seller looks at his costs and then he posts the price that I will sell so many units of goods at such and such price. And everybody posts the price, and now they are fixed. Once they have posted the price, they cannot go back and revise. This is the standard structure. You announce the price, and now, as you say, you announce a price, okay, I'm selling at 50 rupees, and now 10 people come in, and you say, there's high demand, so I'm going to change this price to 75 rupees. Well, technically it would work, but actually everybody will go away from you, and they will consider this as cheating and unfair. And so, even though you see excess demand, you don't change the price. So posted prices is the standard market mechanism. So the question is, how do posted prices work? Well, I really did a lot of hunting for this posted prices because that's the next unit in Holt and Davis, and that book is old. I wanted some recent literature, but I couldn't find any literature. All of it is because this literature doesn't. Oral double auction, you can find articles in 2001, 6 and 7, but posted price is very difficult to find literature. Why? Because this is against the ideology of neoclassical theory. So the typical result in posted price auction is that you have low efficiency, the sellers extract a lot of surplus, prices do not adjust quickly to change, or the price adjustment is slow. So all of these results are actually true about real world markets, but these results are not liked by economists, and so they are not easy to publish. So I'm now going to go through the article. This is the standard supply and demand setup for a market experiment in this type of setup, the oral double auction works. As I've said, in this one what you will see if you run an oral double auction is that the last price is very close to equilibrium, and this happens because basically the trades take place along the Marshallian path. Also, there's one more thing, that it's not necessarily true that every last price is close to equilibrium. It's just that if you run this experiment a lot of time, the average price, last price, is pretty close to equilibrium. Because not every trade, because there's lots of randomness, so not every time you don't follow the Marshallian path, but on the average you tend to follow Marshallian path. So, also the second result would be that the average price in every session would be competitive equilibrium. That's because the triangle that you see on the left hand side of this diagram, if you just negotiate at random within this triangle, then the average will be at the competitive equilibrium price. And this is because the supply and demand is symmetric. If we made the supply more steep or flat, or if we made the demand flat, then those points would cluster in the triangle, but now they would not average to the competitive equilibrium. So, so this is the standard ODA story. These are the results for oral double auction. In the first period, you get 7-8 trades. None of them are at the competitive equilibrium, and you see a lot of fluctuations. There is no convergence, nothing. So if we just look at the first period, we can say that the oral double auction disproves competitive equilibrium. But if you do trading in the second period and the third period, you get, second period is more or less converged. There's one price that is too low, and in the third period you have complete convergence. So now this is what is used to argue that the oral double auction proves convergence. But as I said, the second and third period, what real world phenomena does this capture? In order to argue that this proves that competitive equilibrium holds in the real world, you have to find me a real world situation for which this is a good model. And I don't know of any real world situation in which you can argue that the same demand and the same supply is repeated on a daily basis or on a period by period basis. In the real world, things continuously keep changing. Both demand changes, supply changes on a minute to minute basis or a day to day basis, and there is just no way to argue that this is going to be the same. In the market for tomatoes, every day a different number of trucks arrives and a different numbers of consumers are there. So if the supply and demand fluctuate from day to day, then this idea that we take exact same supply and exact same demand and repeat it and you will get convergence, it doesn't have any meaning. It's just an artificial way to force convergence to competitive equilibrium. But okay, we concede this point, we continue. We say that okay, instead of oral double auction, which doesn't actually happen, let's look at the same market and the same repetitions, but let's use posted prices. So the sellers have to announce their prices, and then they must maintain these prices for the period. Okay, they get to change in the next period. Let's see what happens then. So in that case, what we have is the Bertrand price competition model, which you have studied, I'm sure. Basically, this is a different model because actually, you see, Bertrand price competition model is not studied very much because it leads to very trivial results. If you have two prices and one price is lower than the other, then everybody goes to the lower price. And so the Bertrand price competition model is just mentioned as in a line or two or a paragraph in the textbook because it doesn't lead to anything interesting because of the wrong assumptions about the model in textbooks. They say that automatically everybody will go to the lowest price. Now, we know in the real world it doesn't happen, and we know that in this experiment it will not happen because even though different persons have announced different prices, everybody has only a few units to sell. There are what is called capacity constraints. So not everybody can buy from the lowest price. So because of that, even those people who have higher prices, they will get to sell their product at the higher price. And so you won't see immediately all people selling at the same price, which is what happens when you do it in the textbook format, where there are zero transaction costs and there is full information and there is no capacity constraint. Every seller can sell infinitely many units at whatever price he is announcing. Yes. Sure. So now, if we take a Bertrand price competition model and we put it in a realistic setting, then we immediately get what is the most common feature that we see in the real world, which is heterogeneous pricing. Whereas economic theory tells us there is the law of one price, and they don't understand why the same object can sell for multiple prices. In this model, it will immediately happen. Everybody will announce a different price because they don't know what the other person is going to announce. And now, according to economic theory, what will happen is that only one person will be able to sell, but in reality this will not happen. So heterogeneous prices will occur, and they will be real, and they will not be immediately eliminated by competition. Why? Because of capacity constraint. If it was true that every seller could sell as much as he wanted to at that price, then again economic theory would work, and it would be true that at the posted prices only the lowest price person would get to sell and everybody would buy from him. But because of capacity constraints, this doesn't happen. So one of the important differences between posted prices and real world and economic theory is heterogeneous prices. Of course, oral double auction also yields heterogeneous prices, but the economists ignore that. The second thing which happens is that the sellers extract much more surplus. Now, this is not immediately obvious. Why? Because it seems that they have to fix a strategy, and the buyers are flexible, they can choose. So it would seem that the buyers have the advantage, but actually what happens is that the sellers have the advantage, because it's like an ultimatum game. The seller says, you have to buy at this price, and that's it. I mean, I'm not making any concessions or discounts. So the buyers have no bargaining power in this game. They either accept or they reject. So because of this, in the ultimatum game, the person who gives the ultimatum has the advantage, the upper hand. In principle, he can offer only 1 unit and take 99. So just like that, the buyers achieve greater surplus. The sellers have higher surplus. Buyers have less surplus. So supply and demand equilibrium doesn't work. Efficiency fails. Trading is low. These are the standard results of posted price markets, which are available from various articles, but these are not highlighted, not picked up, not mentioned in the economics literature, because they are against the ideology. Okay, so these are the results in posted price markets. So this is exact same setup, but instead of oral double auction, what we say is that the sellers announce the prices. So in the first period, the pluses are the 3, there should have been 7 trades, but there are only 4. People announce prices. The 4 square dots are the prices which were accepted. So these are the trades that took place. The pluses are the 3 prices at which were announced. They were posted by the sellers, but there was no buyer. So actually, this is fairly big loss of efficiency. Now in the second period, the highest price was not posted again, but all other people posted prices at the 2 highest prices that the sales were made in the first period. Look at that, right? There's the two dots which are the highest. These are the two sales that were made. So there's learning that's taking place. The sellers say, okay, this price we can sell. So more people made, about 4 people posted those prices exact same as the one, and one person posted a slightly higher price, but didn't get a buyer, right? The plus. So he was testing to see if maybe this is not the equilibrium. And then there were 4 people who posted low prices actually at competitive equilibrium, and those 4 also got picked up. So there were 8 trades that were made and 1 sale that did not go through. In the third period, the 4 sellers who were at competitive equilibrium, they raised their prices because they see that a lot of sales are being made at a higher price. So all of the prices are above equilibrium. The plus, the one guy who did not make a sale, he reduced his price to the last period equilibrium. But all of the 4 prices reduced even more. So everybody's influenced. The 4 people who made sales said that there are 4 sales that are at lower price. Maybe we should play it safe and lower their price. So the third period, again, all sales take place above equilibrium. In the fourth period, again, most sales, 2 sales take place at competitive equilibrium and 4 sales take above. And in the fifth period, 5 sales above equilibrium and 1 inside and 2 non-sales. So only 5 trades are made. So again, all of this is inefficient, and this is quite different from the standard behavior in ODAs. We have slow convergences, prices are high, trading is low, and these are all different results from the standard ODA models, which show rapid convergence to competitive equilibrium. So basically this result, Davis and Holt show, these results are valid in a large number. There is a lot of literature on this, and basically these results have been reliably replicated in many experiments, that none of the ODA results hold in markets with posted prices. So now we can argue that if posted prices is the better model for real world, then competitive equilibrium fails completely. So for one thing, collusion and conspiracy is more likely. There are ODA results in which people were allowed to collude to set prices, and even in those experiments, the collusion didn't work. It broke down, and ultimately convergence to competitive equilibrium took place. So again, this was a source of great comfort to neoclassical theory, because that's what they argue, that competitive equilibrium works even when you have small number of traders and even if you have possibility of collusion, because it will break down due to the pressure for competition. But in posted prices, it doesn't work like that. So capacity constraints lead to differential prices. Again, one of the assumptions of competitive equilibrium is that if you have a producer who has some cost, then he can supply indefinite quantities at that cost. If that doesn't work, then you have capacity constraints, and so then you will have differential pricing, because only a few units are available at a low price. There's a heavy advantage for sellers. Again, you see in the competitive equilibrium, the sellers and buyers are symmetric, and the same thing is true in oral double auctions, and so there is no advantage to the sellers. But basically, as I've said in other places, economic theory is actually capitalist economic theory. It favors the capitalist, and it's against the interests of the public. So here again, the model says that it's symmetric, there is no advantage to sellers, but the posted prices actually favor the sellers. Competition does not work like it is supposed to. There is low volume of trade and low efficiency. So these are general results established over a wide range of posted price experiments. the market structure matters. Small details in how we set up the rules can make a big difference in the outcome. Now, once this is realized, then if we want to create a good model, then we must go to a real world industry and look at exactly how it works, what are the trading rules, and then we can do an experiment. It is not true, you see, the economists believe in magic of markets, so they say no matter how you set it up, as long as you have supply and as long as you have demand, it will magically converge to competitive equilibrium. But since once we understand that it doesn't happen, and economists do not understand that this does not happen, then if we want to set up a real model, then we have to look at a particular market. What is the market for housing like? When do the students arrive? What are the exact are the owners advertising in newspapers? How do the students learn the information? All of these things make a difference because microstructure matters. But in economic theory, the students magically have all the information about all of the houses, and the housing owners magically know all of the demand curve, and then automatically convergence occurs. But if magic is not there, then we have to look at exact structure, the structure of information, the structure of decision making, everything, and all of these things will make a difference in terms of what happens. In particular, one of the important results is that prices do not, in ODA, convergence happens quite rapidly, and if you change the market structure, people quickly learn that things have changed. But in posted prices, this does not happen. There is a very sluggish price response. This supports the Keynesian ideas of sticky prices or rigid prices, and it has very important implications for monetary and fiscal policy. So, this particular paper, this is just a review of other results, but this particular paper says that I'm going to explore 3 conditions and show how these things differ between posted price markets and oral double auction. So one of the conditions is what happens if there is fluctuations in demand. So this is the first condition. There are 3 different conditions that we're going to look at, and look at the differences between posted price auctions and oral double auction. So this is the first condition. Here you have changing demand. So in periods 1 and 2, you have the low demand condition, in which the equilibrium is, which is the solid line, and equilibrium is at $2.45. And then in period 3, the demand rises by 1. At 4, it rises by another unit. 5, 6, 7, 8, it keeps rising. And then in 9, 10, 11, 12, 13, 14, 15, it starts declining. So you have a rising demand for the first 10 periods and then a declining demand for the last 10 periods. So this is to see what happens when in this posted price market when you have rapidly changing demand conditions. So this is a comparison of the oral double auction results and the posted offer. So on the right hand side we have the double auction results, in which you see the equilibrium price is closely tracked. The dots are the last prices, and they are always very close to equilibrium price. This is a standard feature of the oral double auction. And then the solid prices are the average prices. As I've said, all of these conditions, the average price is not really a good measure of what's happening, and also the last price is not a good measure. So this is a very strong misrepresentation of how close oral double auction is to the competitive equilibrium. If we can find better measures of how close oral double auction is, and some people have done that, and then it will not be so close. But in any case, it is true that the oral double auction allows much more revelation of demand structure and price structure. People are there and they are watching, and they see that at some price there is not much demand, at other price there is demand, because the buyers are bidding, and similarly because the sellers are bidding, the buyers can assess the demand, the supply curve. So there is a lot of information generated by the oral double auction. So the convergence is plausible. In posted offer, there is much less information about the demand and supply conditions. And so if you look at the results, the last price doesn't have anything to do, no tracking of competitive equilibrium. The solid curves are for different, there is dotted curves. These are all different sessions of the same experiment. So you see that the posted price adjusts to the increasing demand, but very slowly. So it keeps going up, and then once the demand starts coming down, it still keeps going up because the adjustment is slow. And so in the last few steps, the demand, the average prices are very high compared to the compared to the equilibrium price. As a result, trading is very low. A lot of people simply cannot buy at the high price. So market is highly inefficient. So the posted offer results are very different from the oral double auction results. So one very important difference between economics methodology and scientific methodology is that the economists start with a theory which they know to be true in advance. So they are just looking for confirmations. If they find that the observations reject, the experiment rejects the theory, then they say the experiment is wrong, our theory is right. If they find that the real world observations reject the theory, they say the reality is wrong, our theory is right. So what scientific theory does, it looks for rejection. Now when the theory is rejected, this is an opportunity to improve the theory. So now how do we improve the theory? We have to, one of the things that experiments reveal is that you cannot ignore the market structure like the economists do. The economists say, okay, we have supply, demand, magic, we have equilibrium. People say no. Yani experiments tell us no. We have to look at how this supply is actually works in the market. So for example, if the trucks of tomatoes are arriving in the market and we get to see the number of trucks, this is a different structure. And if you don't get to see the number of trucks, it's a different structure. If the trucks are arriving throughout the day instead of all at the morning, then that will be a different structure and it will lead to different results. So exactly how the real world structure matters. It's not that demand, supply, magic. So that's one of the things. And then how do we find out what happens in a structure? Well, we have to do the calculations for that particular structure. So that how do people learn information? How do they act? All of these things are open questions. And these are the things which experiments can be used to find out. So now, since economists are not looking for rejections, so they don't allow the publication of rejection papers in their journals. So ODA can be, so this is actually very seriously, if you look at the papers of ODA which are published, they all take this point of view that ODA is proving economic theory, even when the people who author the paper know that this is not true. They have to present the results as if it is confirming, because they want to get published in journals and get impact factors and get promotions. So ODA has the advantage, that's why lots of people work in that area, because even though it has no resemblance to real world markets, because it can be put in a light which says that this proves markets, and so you can get publishable papers out of ODA experiments. You can't get publishable paper out of posted prices. You can also take ODA experiment, as I did, and show that ODA proves that competitive equilibrium doesn't work. But nobody has written a paper like this, and there's no publications like this. Okay, so Davis and Holt said that, okay, posted price doesn't work, but let's suppose that the reason is lack of flexibility, which occurs in ODA. So let's introduce some flexibility. Let's say that the person who posts the price can offer a discount. So in the experiment, they say that the buyer can press a button. It's all computerized, and this will go to send a message to the seller saying that the buyer is interested in buying if you offer a discount. So now the seller can decide whether or not to give a discount or whether to stick to this price. Also, if a seller is not making sales, he can introduce a clearance sale that, okay, temporarily I'm lowering the price because my goods are not selling. So all of this introduces flexibility. It improves things a little bit, but doesn't get to convergence. So it has this effect that we would expect. Prices are a little bit lower, volume of trade increases, but doesn't get you convergence to equilibrium, which is what we want. It helps, but only a little. So one of the real-world implications of posted prices is on Keynesian economics. Now, in Keynesian economics, if you have a negative demand shock, then the market collapses. You get zero trades or very low trades. And prices, you see, what should happen according to Neoclassical is that the demand collapses, the prices should also collapse. And once the prices collapse, then the markets will pick up things. But the problem is that prices do not collapse in posted price markets. The prices stay high, just like we saw in the experiment. The demand kept declining, but the prices stayed high. They did not show any declining trend. They just stopped increasing. So because of that, the market collapsed because the price is too high for the level of demand that exists. But the prices did not go down. So this explains Keynesian economics, and that explains the need for aggregate demand management. And if the prices are too high and the prices are fixed, then then the economy will collapse, and the only thing you can do is to pump up aggregate demand. Now, so this explains the need for aggregate demand management, explains Keynesian economics, which, see, economists say that Keynesian economics lacks micro foundations because if people are optimizing and equilibrium arises, then there cannot be fixed prices. But the reality is that the prices are fixed. So basically what Keynes said is that economists resemble Euclidean geometers who are in a world in which the geometry is non-Euclidean. So in Euclidean geometry, you can only have one parallel line through a point. In non-Euclidean worlds, you can have multiple parallel lines. So the economists find that their Euclidean axioms don't match to reality, so they keep scolding the lines that why are you doing this silly thing? You shouldn't be, parallel lines shouldn't intersect, and you are intersecting. So instead of adjusting their theories, they keep scolding the real world for not behaving properly. So here also, Lian and Plot, they constructed a macro model, and they find that there are no business cycles and no Keynesian philosophy, no Keynesian phenomena. The wages adjust quickly, contrary to Keynesian theory, but they use oral double auction, and they got a publication. So the thing is that if you don't use oral double auction, if you use posted prices, you would get the macro phenomena Keynesian, but then you wouldn't get a publication. So most people prefer to get publication and unrealistic assumptions rather than realistic assumptions and no publications. Okay, so that was exploration of what happens with posted prices in markets with fluctuations in demand. Now the part 4 of this Davis Holt Brazilian article is that you have market power. In ODA, market power experiments show that sellers are unable to exercise market power. But with posted prices, this result is not valid. If you have small low-cost sellers, and if you have large high-cost sellers, then the large high-cost sellers can dominate the market. Because the small low-cost sellers can supply a little bit, but since they don't have infinite supply, they cannot make the market, as it were. And they cannot break the power of the high-cost sellers to set prices above equilibrium. So if you have large sellers, see what they can do is they can withhold units from the market. That will change the supply. Now if they withhold units, they can increase the supply, they can increase the prices, and so they make a loss by not selling, but they make a profit by increasing prices. And there are many situations in which the additional profit they can make by withholding supply more than compensates for the loss they make by not selling a few units. Especially if these are high cost units, you see. When you have high cost units, then the profit you make from selling them is very small, so it's easy to just take it off the market. The assumptions in which we are working is that these sellers are wholesalers, so they're not actually producers. So it means that if they don't sell, they don't lose the cost of the thing. They only fail to make the profit because they buy from somebody, and so they say, okay, I won't buy, or they are allowed to return the thing at cost to the experimenter, or they do not buy. In either way, they don't incur the production cost. If they incurred the production cost, things would be different. As I said, microstructure matters. So one experiment we will see is that in an experiment where the demand and the supply curve remain exactly the same, if you take the units and you distribute them equally among the sellers, you get the competitive equilibrium. But if you rearrange the units so that some of the sellers are big and some of the sellers are small, and then you can get a different outcome. So even though the supply and demand curve remains exactly the same. So this illustrates that market power matters. So this is the essential lesson of this part 4. So again, this has to do with microstructure. Microstructure is basically, by that I mean anything outside the supply and demand curve. So here, the two situations where sellers have different supply, different capacity constraints, the supply and demand curves remain exactly the same, but exactly how the microstructure changes and the outcome changes. Alright, so this is the example from part 4. There are two designs. One has no market power and the other has market power, and different outcomes results. So in design 1, you have 5 suppliers, and you have S1, S3, and S2. All 3 of these suppliers have 2 units at the high cost and 1 unit at the low cost, and S4 and S5 have 1 unit at low cost. That you can see from the supply curve, right? And the demanders, you have 8 demanders with high value and 3 demanders with low value. So the demand curve has 2 parts, and the supply curve also has 2 segments. And so basically the competitive equilibrium will be between these 2 prices, the low value for the buyers and the high cost for the sellers. So so these are the 2 possible outcomes in competition. Now the market in design 1, basically, in order to be able to get a high price, you need to be able to take 3 units of the market, because the fourth unit, if the aggregate supply is 8, then you can ask for a higher price. The aggregate supply is 8, yes. If there are only 8 units, then you can get the high value. If there are more than 8 units, then you will have to sell to the low value seller, and if there's only one price, then it has to be less than the low value of the buyer. So now in the first design, there is nobody who can who can block 3 units. But in the second design, in design 2, S1 has 4 units and S2 also has 4 units. So if either one of them withholds 3 units, then they can sell 1 unit at a high price. Right? So the last 3 units are valued at the competitive price, and so if anyone raises price above the competitive price, then he will face demand for only 8 units. Now 8 units can be supplied by the other buyers, other sellers, so he cannot sell within the first 8 units his unit. So there is no market power in the first design. In the second design, each of the 2 large sellers, S1 and S2, have 4 units. So now if they withhold all 4 units, then all of the remaining buyers can sell between them only 7 units. So there is 1 unit of high value demand that is left, and he can sell 1 unit at the high value. So in this second design, you have market power. So the supply and demand curve are exactly the same, but by changing the capacities of the sellers, we have created market power. Now let's see what happens in the posted price. Now the thing is that in this example, in the oral double auction, this doesn't help. In the oral double auction, you get to competitive equilibrium, but in posted prices, something different happens. So here is session 2. This is called the tacit collusion, in which the sellers are not allowed to communicate with each other, and they're not allowed to make any conspiracy to raise prices. So in the first outcome, you see the pluses are the prices which were posted by one of the sellers, and as you can see, they are at the high value of the demand. I don't know how he found out that that's the demand, but anyway, he is asking for the highest value. Oh, this is in session 2. Okay, now I understand. In session 1, there was exploration and the high value was discovered. So now in session 2, people know what the high value is. And so seller 2 is holding out for the high value. He's giving basically zero surplus to the buyers. Now in the first 2 sessions, he doesn't make a sale. The square dots are the sales. S1 is keeping low prices, and basically S2 maintains high prices all the way. In the third period, he lowers the price temporarily, and then he goes back to the high price. And generally speaking, the prices remain way above competitive values, but they are also not at the monopoly price. They remain in the middle somewhere. In session 2, where there is no power, then the prices start out at the monopoly, but they quickly decline to the competitive equilibrium and they converge. So 30 periods of power play and 30 periods of no power play. In the no power play, the posted prices converge because there is no market power in the setup. But it takes them quite a while to converge. Now, he wanted to assess the effect of what happens if we allow sellers to collude explicitly, and also we don't allow discounts and there is no market power. So in this case, what happens is that you get convergence to equilibrium.
Is there collusion in here?
This one has no collusion, no market power, no discounts. This is now a second part of the paper. Here we are allowing collusion by posting prices. This is a very important lesson from posted prices, that when you post prices, this creates opportunity for close collusion because people can just see what other people are doing. So here there is a price signal that, look, I'm selling at a high price and you can also. So that is all, and that is enough to prevent the competitive equilibrium from emerging. No explicit here. Okay, so just for a baseline, he says, okay, no seller conspiracy, no discounts. Now here is the session with seller conspiracy and no discounts. This is now a situation where the buyers go out of the room, the sellers are allowed to conspire, but the buyers don't know that they are allowed to. They think that they are not allowed to. So the sellers can agree among themselves to set whatever price, a collusive price. So that would be the monopolistic equilibrium at the top line. So it turns out that, contrary to the theory which says that, okay, what happens is that they make an agreement, then they go back and they can do whatever they like. And so according to the theory, this would break down, the oligopolistic equilibrium would break down because individual interest would be against the group interest. But it turns out that, except for period 12 where there was some cheating, people didn't stick to their collusive agreement and the price went down, then they went back to monopoly. So in all periods, basically you are at monopoly or slightly above or slightly below, and you are nowhere near the competitive equilibrium. So the market is competitive. You have Bertrand price competition. That's what's taking place because people post prices and there is competition. The buyers can choose among the prices. So there's clear-cut Bertrand price competition. But it doesn't lead to competitive equilibrium, contrary to the predictions of theory. The sellers, when they are allowed to collude explicitly, they can fix prices at joint profit maximizing level. Aggregate consumer and producer surplus is low because you are having monopoly, so you have low volume of trade. And these results are typical for posted offer conspiracies and are well known. So he has some references, but not much literature. 84. Alright, now this is very interesting. Now you get convergence when you allow secret discounts. So the seller is allowed to discount the price. I mean, they have a posted offer, but if somebody asks him for a discount, he can give it, and this will not get publicly knowledge. So now with secret discounts, people start making secret discounts because as the theory tells us, the individual incentive is not aligned with the group incentive, and the individuals have the incentive to sell more units at lower prices. Standard oligopoly issue. So everybody starts giving discounts because it's secret. The posted prices start coming down, and eventually they come much closer to equilibrium then, before. So the secret discount does work to as the theory says it should. However, it turns out that if the discounting is not secret, then it doesn't work. So if you are forced, even ex post, if you are forced to report that I gave a discount to some, then people can find out and then they can prevent this from happening somehow. Public revelations of what's happening can create exactly contrary to the competitive prediction, that the more information you have, the more competition should exist. But in fact, in this particular situation, keeping prices secret helps competition. This is contrary to intuition, contrary to theory. So there is a paper about that. I have assigned 3 papers to the students. One of them is about this issue of whether prices should be posted or not. This was a real world practical problem that emerged. All 3 papers deal with real world problems and how we can solve real world problems using experimental methods, and also that these real world problems cannot be attacked by standard neoclassical methods because they make the same prediction in all cases, and so they cannot differentiate between the microstructure problems that arise in the real world. So basically the lesson that we get is that posting prices usually leads to non-competition, but in some situations we can get to competitive behavior, but it has to be done exactly correctly. Now the third part of this paper explores the diamond paradox, which is that if you have a small search cost, this can lead to monopoly pricing. And why? It's very simple. Any one seller can raise the price slightly below the search cost, so that this may have no effect on equilibrium, because somebody who comes to him will say that, okay, my search cost is higher than the amount that he is charging excess, so I might as well give it. So now everybody can raise the price by a small amount. But now once everybody is at this new small amount higher than competitive, then everybody can again raise the price by a small amount, and eventually it should converge to the monopolistic equilibrium. So does this actually happen? So you run an experiment to see with search costs, and so you find that yes, indeed, the search cost matters. If you have search costs, you have fairly high prices, but sort of more or less in the middle of the competitive and the monopolistic price, slightly closer to the monopolistic price, but you don't have convergence to monopoly. As opposed to this, if you have zero search costs, then in the first session, the posted offer, and also in the second session, it goes pretty close to the competitive equilibrium. So the results from these experiments is that search cost matters, equilibrium prices are significantly higher, but there is no convergence to monopoly price, contrary to the diamond paradox. So why is there no convergence? Especially because there is a paper, Grether, Shorts and Wild, in which they do get convergence to monopoly. So the authors speculate that there are 2 differences, and now this is an open question which they plan to investigate, but which they never did because they couldn't get this paper published. So they said, why work more? So basically they said one of the things that the Grether, Shorts and Wild did was that they showed before the search began, they showed all the prices to the buyers, that this is what's available. Now you can search or you can not search. So apparently that might be the thing which makes a difference. And they said that, look, in the real world you don't know the distribution of the prices out there. This is a very unrealistic assumption. This is actually assumed by the full information people, that when you start the search, you know the distribution from which you are searching. And that's not true. But the point is that if you want to do optimal search, then you have to know the distribution. If you don't know the distribution, there is no optimal search. So that's why they make this, because they want to optimize, but the optimization assumption itself is flawed. So the second difference is that in this Davis Holt paper, the people did not know when the game would terminate. They just keep playing, and they were not told that when this sequence will terminate. So now when you have an infinite game, there are some very complex strategies which emerge, and they speculate that maybe that's the reason. So they don't know why there is such a big difference between the Grether-Schwarzschild and the results. More experiment is needed to find out. So basically the conclusion is that posted prices are more like real markets. Real markets are not organized like oral double auctions. Posted prices give results which are much closer matched to what we see in the real world, in that we have differential prices, same goods selling, no law of one price. Shifting demand is not immediately compensated by changes in prices. So you have rigidity, price rigidities. You have market power. Market power can lead to substantial increases prices, and this arises due to capacity constraints, because you don't have infinite supply available at the same marginal cost. You can have price fixing, you can have collusion. All of these things make a big difference, and that's what we see in the real world. Now, okay, so these are the three papers that I have assigned. All of these examine different real-world situations in which the results are quite different. And the thing I want you to understand is that to learn about which of the two different policies would be the right policy to use, you have to do experiments, because economic theory doesn't provide any guidance. Because as long as the supply and demand is the same, economic theory says magic, competitive equilibrium, so it will all work. So, but it's not true in the real world. And the economic theory doesn't have any guidance as to what will happen when competitive equilibrium doesn't hold, because they don't have any theory of disequilibrium, they don't have any theory of learning, they don't have any theory of decision making when you don't have optimality. So when we are making decisions under conditions of no knowledge, then there is no optimum. I mean, I choose between option A, B, and C, and I don't know what will happen if I choose A, so I can't maximize, because I don't have the probabilities of the events that are happening. I don't know exactly what the outcomes will be. I don't know what the other players are going to do. So basically there is something which is called uncertainty. Uncertainty is when there are different kinds of things which can happen and you don't know what the probabilities are and you don't know what the outcomes are. As opposed to this, there is risk. Risk says that there are 7 different options. All of them have known probabilities and all of them have known outcomes. That's the situation where expected utility theory works, and that tells you how to optimize. So now what happens is, in the real world we have uncertainty. What economists do is this: they convert this uncertainty into risk. They assign probabilities to everything, they assign values of outcome to everything, then they make the optimal calculations, because they are ideologically wedded to the idea that you have to have optimizing behavior. So they cannot look at the real human behavior, so their models are terrible. Alright, so I have given you these 3 papers. On next Monday you will be doing the presentations, and I want you to learn how to do presentations and try to understand this paper. You can read related literature if you can find some, if you like, and you can even run experiments if you like. That will be ambitious and difficult to do, but as I said, all of these are open questions. You see, these papers are 1980s. People don't write papers in these because they don't get published. Alright, so that's all for today.